Today we're going to be talking about the numbers that I want you to know before beginning the process of home ownership. There are 6 very important numbers that you need to figure out before you begin the whole process. Number 1 is your income, 2 is your credit score, 3 is your DTI, 4 is knowing the number of years you have been with your employer, 5 is your savings, and 6 is being able to calculate the amount that you can afford for a future mortgage. When you get pre-approved for a mortgage, your lender is going to look at 3 areas: your income, debt, and your credit. So once you have all those things under control, anyone can buy a house. So let's start off with number 1, your income, how much money you make. This will be your determining factor as to how much they will lend you. They are going to be looking at your bank statements, your W-2s, your check stubs, your tax returns. So you're going to want to know all this information and have these forms available for your lender. Number 2 is your credit. There are 3 credit scores from Experian, TransUnion, and Equifax, and they're going to look at your middle score. Not the highest, not the lowest. They're going to take a look at that middle score. And that's what they're going to use to qualify you. The guidelines for FHA loans say that you need like a 580. However, lenders can put their own requirements for the credit scores. So what I'm finding is, typically speaking, you need about 640 at least for most lenders. But in order to get the best interest rate, you want to have at least a 740. So it's good to know your credit scores ahead of time using credit monitoring sites like Credit Karma, CreditWise, Credit Sesame. And these sites are not going to give you an exact score, but at least it will give you an idea as to where your score falls. Let's go to number 3. This is also very important, and it's your debt to income ratio. You know your income, you know your credit. Now let's talk about your debt. Your mortgage relies heavily on your debt to income ratio. The mortgage company does not want to lend you money if they feel like you have too much debt already, which makes sense. You want your debt to be as low as possible, but generally speaking, 43 to 50% debt to income ratio or lower is acceptable. And to calculate this, you just take your monthly debt payments and divide it by your gross monthly income. Your gross monthly income is the amount of money that you have earned before any taxes or deductions are taken out. All right, let's move on to number 4, employment. Typically speaking, lenders like to see consistently 2 years of employment history, so keep this in mind when you are ready to buy a home. Number 5 is savings. You will need some money to put down for a down payment and for those closing costs. So you want to make sure that you have money saved up to cover those things. Now, there are some financing loans to help cover these costs when buying a home. So it's important to talk to your lender and find a loan or a program that works best for your situation. And the last thing I want you to do is calculate your future mortgage payment. So if you were to buy a $200,000 house, you should know what your monthly mortgage payment will be. It'll just be an estimate, but try to include your taxes, your insurance, your principal, your interest, and everything that's tied with your mortgage. Your lender can also help you come up with an estimate of your future monthly mortgage as well. So you can also ask them to help you out. But this will just be a good way of you gauging how much it's going to cost you per month to own a home at that cost. All right, those are the 6 numbers that are so important to know before you begin the home buying process. If you enjoyed this video, please give it a thumbs up, subscribe, and be on the lookout for my next video.